Hey guys, welcome back to Chapter 6. This is motivation for fraudulent financial reporting, really discussing the motivations for it. At the end of this chapter, you need to really understand the characteristics of earnings management. You need to explain the purpose of providing earnings guidance and motivation for making false and misleading disclosures. You want to be able to explain how an auditor might look for red flags that indicate fraud and how that might exist in the financial statements. You need to explain the working of financial shenanigans and its effect on reported earnings, and describe the makeup of non-GAAP amounts and whether they distort reported earnings. So financial statements must be relevant and reliable. So relevance means the information being reported is meaningful, and reliability refers to the accuracy with which financial data is reported so that the users know the information can be trusted. I like to ask my classes, can something be reliable and not relevant? And can something be relevant and not reliable? And so just to quickly give you an example of each, something that would be relevant but not reliable would be the financial statements after last month. Let's look at them. It's relevant, it's timely, it's important, but it wouldn't be reliable if you couldn't trust the numbers, if they were wrong, if there were mistakes. So it would be relevant, not reliable. Then what would be reliable, not relevant? Well, what happens if we're making a decision today, but you went down in the hall and got me financial statements from 10 years ago? Now, they're audited, they're reliable, they're accurate, but they're not relevant to what we're doing today. So something can be relevant and not reliable, or reliable and not relevant. You want both. You want relevance and reliability. So an important quality of useful information is representational faithfulness. To represent the transactions and events faithfully in the financial statements. The effects of transactions and events should be reported on the basis of their economic substance instead of legal form of the transactions. For example, if a company sells an asset but it is still responsible for maintaining it or has other risk of ownership, then reporting that transaction as a sale instead of a secured loan does not faithfully represent the transaction, and thus would distort the effect of the transaction on reported amounts and potentially mislead the users of the statements. Fraudulent financial reporting occurs for a variety of reasons, including making the company look like it's doing better than it really is. Some companies manipulate GAAP in order to achieve a higher level of earnings and mislead investors or creditors about the company's current and expected future earnings. Oftentimes, the motivation is to meet or exceed financial analysts' earnings projections in order to maintain or increase the company's stock price. Companies use a variety of techniques to produce fraudulent financial reports, including accelerating the reporting of revenues and delaying the reporting of expenses, oftentimes by manipulating accrual amounts. These are called financial shenanigans. Given the number of estimates and accounting choices to be made to produce financial reports, it is up to auditors to ensure they capture economic reality and are not manipulated by management in order to cook the books. A skeptic might say that an unmodified or an unqualified audit opinion means the financial statements have been prepared in accordance with cookbooks under GAAP. Companies seem to look for any advantage when they report GAAP earnings results. One approach has caught on with virtually all public companies is the reporting of non-GAAP earnings in press public releases based including on social media or in conference calls with investors, financial analysts, and in quarterly financial reports. For an example, in a report issued by the Center for Audit Quality, 94% of S&P 500 companies include at least one non-GAAP financial measure in their earnings releases in the first quarter of 2020. Companies have great latitude in choosing what they report as non-GAAP metrics because FASB has not set any rules in that area, even though it is in the public interest to do so. So in this chapter, we examine the motivation for producing materially misleading or fraudulent financial reports and the techniques used to do so. We also identify the red flags which signal the need for heightened professional skepticism. Auditors must act when red flags are present to ensure that fraud is detected and corrected. The fraud triangle discussed in Chapter 5 provides guidance on what to look for in making that determination. There are consequences of managing earnings to achieve a desired goal rather than to faithfully represent reality or what actually happened during the year. These are discussed in Chapter 7, including when and how financial statements need to be issued or restated, and to inform users they are no longer should rely on the original financial reports. So a couple questions to consider in Chapter 6 are: what motivates fraudulent financial reporting? Now, what is the motivation for it? Usually it's self-serving in some capacity. How are financial statements manipulated to achieve a desired goal? And accruals can be a good way to do that. You can, when you recognize things as far as expenses or revenues. What are the red flags to look out for in spotting techniques that can lead to material misstatements of the financial statements? Also, why do companies provide non-GAAP earnings? What's the reason behind that? So, Arthur Levitt, the former chairman of the SEC, said, "Increasingly, I have become concerned that the motivation to meet Wall Street earnings expectations may be overriding common sense business practices. Too many corporate managers, auditors, and analysts are participants in a game of nods and winks. In the zeal to satisfy consensus earnings estimates and project a smooth earnings path, wishful thinking may be winning the day over financial representation." So that's an important thing to keep in mind, that you really want to represent the right way. And Warren Buffett once said that earnings can be as pliable as putty when a charlatan heads the company reporting them. And so it's important to have ethics at the very top as well. So guys, always remember, you guys are led by a good shepherd. He will teach you the right way to go. Just listen to his voice. Be led by him, and that is the right way to do things. If you guys have any other questions, let me know, and I hope you have a great week. God bless.